you can go further with your study of the share market, you need to understand some things about how it works, and also about how listed companies are structured. A lot of the data given in the share market is given as per share data. In other words, things like earnings per share, dividends per share, net asset value per share, and so on. So it's very important for us to be able to establish exactly how many shares a company has issued. And that's not as easy as it sounds, because companies are continuously issuing new shares, and they also sometimes buy their own shares back. In this webinar, I'm going to examine two important concepts: the concept of primary and secondary markets, and also we're going to look at issued share capital and how it changes and how you can calculate it. Let us begin by discussing primary and secondary markets. You may not be aware of it, but there are actually two markets running side by side on the Johannesburg Stock Exchange. In the primary market, companies, listed companies, sell their shares to the public in order to raise funds to build their businesses. And in the secondary market, those same shares are then bought and sold between members of the public. Most of the trades on the JSE are done in the secondary market between members of the public, and primary market sales of shares are relatively rare. It's important to understand that no direct benefit goes back to the company from a secondary market sale of shares. In other words, if citizen A sells his shares to citizen B, the company doesn't benefit. At least not directly. Indirectly, the company does benefit, because in order to have a good primary market, we say you've got to have a good secondary market. In other words, people would not buy their shares from a company in the primary market if they were not sure that they could then sell them later in the secondary market when they wanted to. So running a good secondary market where your shares are highly rated and liquid, in other words, easy to buy and sell, is very important for companies. Let us now move on to the second concept. The second important idea that I want to discuss is the difference between authorized and issued share capital. When a company is formed, it applies to the Companies and Intellectual Property Commission, or the CIPC, for authority to issue shares, in other words to sell them, to the public. And normally that authority is given. It can then sell those shares to the public in order to raise the funds it needs to start or to build its business. But it does not normally sell all of the shares that it is authorized to sell. It only sells those shares which it needs to sell in order to raise sufficient capital. So the authorized share capital of a company is normally higher than its issued share capital. Let us look at some examples from your stock exchange handbook, beginning with Adcock Ingram. Here you can see that Adcock's shares have the code AIP. That's their short code. And that the company is authorized to sell up to 250 million shares to the public in the primary market. But so far, they have only sold just less than 175 million of those shares. Note that the shares are ords, in other words, ordinary shares, and that they had a par value of 10 cents each. The par value is the price for which the shares was first sold to the public in the primary market. Now let us consider Massmart's capital structure. Here you can see that Massmart, which has the code MSM, has an authorized share capital of 500 million ordinary shares, of which they have so far issued only 216.9 million. So you can see that all the listed companies have a different capital structure, and that their capital structure can change on a regular basis as they issue more shares and buy back their own shares. They issue shares for a variety of reasons. They may have an employee share option scheme where they are issuing new shares to their staff members on a regular basis. They also often make acquisitions, and those acquisitions can be paid for partly or fully with new shares. The company can also issue shares to raise cash, as we've mentioned earlier. And share buybacks are done regularly. So the number of shares is always changing. And this is a problem because we obviously need to know exactly how many shares they've got in issue so that we can calculate all those per share statistics. To help us with that, the company normally does these calculations for us and publishes them in their financial statements. Let us look at an example of SPAR's interim financials for 2013. You can see here that SPAR's authorized capital stayed the same at 250 million shares during the period, but that they issued additional shares so that the average number of shares in issue was 1,723 million, while there were 1,728 million shares in issue at the end of the period. Obviously, a company's profits are made throughout its financial period, and so it makes sense to use the average number of shares in issue during that period in order to calculate ratios such as the earnings per share, dividends per share, and the price-earnings ratio. I will explain those ratios in more detail in the next webinar. But when it comes to looking at the net asset value per share, you should use the number of shares which were in issue at the end of the financial period. Sometimes a company, in addition to showing its normal earnings per share using the average number of shares, will also show you the fully diluted earnings per share, which uses the number of shares that were in issue at the end of the financial period, which is normally a larger number of shares, and so the earnings per share would be lower. That is regarded as being a more conservative figure. Let us consider an example. This company begins its financial year with 10 million shares in issue, and then issues a further 5 million shares halfway through the year. And this, of course, gives them an average number of shares issued during the whole year of 12.5 million shares. And by the end of the year, they have 15 million shares in issue. Now, if their profit was 12.5 million rand, then their earnings per share would be 1 rand per share, or 100 cents. But their fully diluted earnings per share would be 12.5 million rand divided by 15 million shares, or 83.3 cents. This example should make it easy for you to understand what is meant by earnings per share and fully diluted earnings per share. So, when you think about the share market, remember, it's got two markets, the primary market and the secondary market. And when you're looking at listed companies and you're looking at their per share data, ask yourself whether it is based on the number of shares in issue on average during the year or the number of shares in issue at the end of the year. In other words, is it fully diluted or not? If you look through your stock exchange handbook, you will find the capital structures of all the different companies which are listed on the stock exchange. Take the time to go through those capital structures and just have a look and see what you can find. You may see some other instruments there like preference shares. These will be explained in future webinars, but you can always go to the glossary and look them up, and that will give you some sort of an explanation. In the next webinar, we will look at 8 important relationships which every private investor should be familiar with.